Japan's 30-year government yield just hit a level it has not seen since 1999. At the same time, Japan is sitting on more than 10 trillion in government debt, while its currency continues to slide against the US dollar. Something is starting to crack inside the world's fourth largest economy, and if debt pressure releases, it does not stay in Japan. It moves straight in the US interest rates, financial markets, and household costs. Today, I want to show you what the data says about Japan's debt problem, why this moment is different from the past, and how this can hit the US even if you do not own a single Japanese stock. Japan's debt is no longer quiet. Most people think Japan's economic problems are old news. They hear about debt and low growth and assume nothing ever changes. That assumption is exactly why the current situation matters. Japan has carried high government debt for decades. For most of the time, interest rates stayed close to zero. That kept the pressure hidden. In 2020, Japan's 30-year government bond yield was below 0.5%. Today, it has crossed 2%. That may not sound dramatic, but when you owe more than 10 trillion, small changes compound fast. Japan's debt now equals roughly 260% of its annual economic output. That is more than double the US level. Every increase in yields raises the cost of serving that debt, and interest payments crowd out spending on infrastructure, healthcare, and growth. Japan's debt worked in a world of near zero rates. Higher yields turn a slow problem into urgent one. Why Japan's debt pulls in the US. Japan's debt problem would still matter even if it stayed domestic, but it does not. Japan holds more than 1 trillion in US Treasury bonds. That makes it the largest foreign holder of the American government debt. Those bonds are not passive investments. They are a source of liquidity. If Japan needs cash to stabilize its own system, it has to sell assets. Selling Treasury pushes bond prices down, and when bond prices fall, yields rise. High Treasury yields ripple through the US economy. Mortgage rates rise, auto loans become more expensive, and business borrowing tightens. The Federal Reserve does not have to raise rates for this to happen. Global capital flows can do it on their own. Japan does not need a full crisis to affect the US. Asset sales alone can tighten financial conditions here. If this breakdown is helping you to understand how global debt actually works, take 1 second to like the video and subscribe. It tells me to keep making this kind of content. The yen trap. The pressure inside Japan becomes even clearly when you look at the currency. The yen tells a story in real time. Since early 2021, the Japanese yen has fallen from around $105 per dollar to roughly $155 per dollar. This is a decline of more than 35%. This does not happen randomly. While the US raised interest rates above 5%, Japan kept rates near zero. Investors follow yield and money flow towards higher returns. As capital leaves Japan, the yen weakens further. A weaker currency makes import more expensive. Japan imports most of its energy and a large portion of its food. That rises household costs across the country. Raising rates would help support the yen, but higher rates would also raise interest costs of 10 trillion of government debt. Japan faces a painful trade-off: protect the currency or protect the debt. Doing both is extremely difficult. Inflation changed the rules. Decades, Japan's biggest economic issue was deflation. That era is ending. Japan's inflation rate is now running around 3%. For the US, that feels manageable. For Japan, it's a shock. For most of the past 25 years, inflation averaged near zero. Households built habits around stable prices, and saving account pay almost nothing, but cash held value. Now that cash loses purchasing power every year. At the same time, wages have not risen fast enough to offset higher prices. The central bank cannot ignore inflation without damaging credibility, but fighting inflation with higher rates makes the debt burden heavier. Inflation forces action, and then action exposes how fragile the system really is. The central bank can't hold the market forever. To understand why bond yields are rising now, you need to understand who was supporting the market and who is stepping back. For years, the Bank of Japan bought massive amounts of government bonds. This policy is called quantitative easing, which simply means creating money to buy debt. Over time, the central bank accumulated more than 50% of all Japan's government bonds. It became the market itself. Because of this, normal investors slowly disappeared from the market. Pension funds, insurers, foreign buyers stopped playing an active role. Prices were no longer set by risk and return, but by policy. That worked as long as inflation stayed close to zero. But once inflation returned, the system had no shock absorber left. There was no deep pool of private buyers ready to step in a higher yields. So even small changes in central bank behavior caused outsized move in bond prices. This is why yields are not drifting higher, they are jumping. The market is relearning how to price Japanese debt after years of being shielded from reality. As inflation appeared, the Bank of Japan slowed its bonds purchases. Most recently, it signaled that it would allow yields to rise. When the largest buyer reduces supports and prices fall, and when prices fall, yields rise. That adjustment happened fast because the market was never allowed to clear naturally. Japan's market is being reintroduced to reality, and the transition is not smooth. Demographic makes the problem permanent. Debt and inflation are serious problems, but Japan's deepest challenge sits underneath both. Japan's population peaked at around 128 million in 2010. Today, it's close to 125 million and shrinking every year. By 2025, projections show it could fall below 100 million. The median age is now 49. There are more people over 65 than under 15. That means fewer working supporting more retirees. A shrinking workforce limits economic growth. Lower growth means lower tax revenue. At the same time, pension and healthcare costs keep rising. You cannot grow your way out of debt with fewer workers each year. Demographic turns financial stress into a long structural problem. Every shock hits harder when the base keeps shrinking. Can Japan escape this? So the question becomes whether Japan can recover or whether it's the end in crisis. The answer is uncomfortable. Japan has strong institutions, advanced technology, and social stability. This is not a sudden collapse story, but it's also not a growth story. The most likely outcome is manageable decline, slower growth, careful debt management, heavy central bank involvement, and technology and automation to offset labor shortages. The real risk is confidence. If investors stop believing Japan can control yields, the pressure accelerates quickly. Markets move faster than policymakers. Japan may avoid disaster, but avoiding disaster is very different from fixing the problem. How this hits your money in the US. Now let's bring this back to US directly, because this is where the consequences show up. If Japan sells US treasuries to support its own system, yields rise here. Higher yields push mortgage rates higher. That affects home buyers, refinances, and anyone rolling over debt. Even a small move in rates can change monthly payments by hundreds of dollars. Higher yields also pressure stock valuation. Stock prices are based on the future cash flows. Higher rates reduce what those future earnings are worth today. And at the same time, a weaker yen makes Japanese exporters cheap. That puts pressure on US manufacturers competing on price. Margin gets squeezed and jobs come under pressure. Japan's debt problem reaches the US through rates, prices, and competition, not through headlines. Japan is the warning shot. This is not just about Japan, it's a preview. Japan is the first major economy to face extreme aging, high debt, and rising rates at the same time. Other countries are moving in the same direction: China, South Korea, parts of Europe. Understanding Japan helps you see what comes next elsewhere. Debt works until demographic and rates turn against it. Then the margin for error disappears. Japan is not an isolated case, it is an early warning. Japan's debt bomb is not about panic or collapse. It's about pressure building quietly inside a system that relied on cheap money for long. If Japan is forced to sell assets or allow yields to rise further, the effects move straight into US interests, household goals, and markets. You do not need to exposure to Japan for this matter. This is what connected global financial looks like when one of the biggest pillars starts to bend. If you'd like to know how I keep my money from inflation, watch this video. And if you like this video, please like and subscribe.